Welcome back, my assets viewers. This time what you are going to see is this. Is that portfolio turnover is adding value to my portfolio or I am losing returns out of it? This is what we are going to see. By and large, the investors always fear when there is a fund which have higher portfolio turnover, they feel it's a bad fund. It is not like that. Although the theory says the desirable limit for a portfolio turnover is always low. It should be low only. But in a dynamic world, when the data is available in a broad way, I don't think the fund managers to be too tightened up to see because don't churn the portfolio. So there is no logic behind it. We see that by and large, the stocks which has been held on to anybody's portfolio, even Warren Buffett portfolio also, they don't buy stocks and hold it for years. At least 40-50% of their portfolio is it has been churned less than 3 years time. 50% would be churned less than 3 years time. That means they also have a portfolio turnover. So what is our concern should be there? My fund manager has churned the portfolio more. Whether he has delivered the return for the amount of brokerage or other charges I paid, is it compensating in my return? That is what we have to see. So now what we thought that we'll try to take for certain funds and then try to evaluate. We avoided for this case study, we avoided large cap because most of the fund managers doesn't change their portfolio in a large cap space. Why? Because the opportunity to make money in large cap space is always limited because the information is available with everyone. So that is mean that they don't change much. Mostly the churn happens between multi-cap, mid-cap and small cap. More so, the churn will happen more in the small and mid-cap rather than even in multi-cap. So it's been order with which the risk is increasing, multi-cap, then the mid-cap, then the small cap. In this order, the risk is keep increasing. So let me see that what we have for this case study, what we have done, we have taken the top 5 performer for this calendar year 2023 and evaluated with a fund which has a higher portfolio turnover. Okay. Unfortunately, all the case study we have taken, the quant is only having higher portfolio turnover when compared to any fund within the category. Okay. So now we have taken the multi-cap. The multi-cap, the best return is been given by HDFC multi-cap. They have a portfolio turnover of 0.9%, 9 times. Okay, 0.9 times they have done. They deliver 41.2% return, whereas 2.4 times quant active fund have churned their portfolio, they deliver 26.3. That means whatever the churn they have done, it is not reflected into returns this financial year. We are not sure whether whatever the stocks he has taken well ahead of times, that means probably next year they may able to perform. This is what happened in Axis Multicap also. When they came out of the NFO, they really underperformed for quite some time in the initial phase. But this year, if you look at it, they are up the chart at 31.9%. Okay. So with a portfolio turnover of 0.15 times, they are sitting with 39. However, the best is among HDFC Multicap with a churn of 0.10. They are at 41.26%. Similarly, we have done, we have compared with the mid-cap fund also. In the mid-cap fund, the top performer is again Edelweiss Mid-Cap. They churn their portfolio 0.55 times. They deliver 40.8% return, whereas the quant mid-cap delivered 36.6% return for a calendar year 2023, but they churned their portfolio 3.3 times or 3.4 times. Correctly, if you have to precisely say, it's 3.4 times. Because although they churned 3.4 times, they underperformed the Edelweiss Multicap, which has churned very less. But there are funds like Canara or Robeco Midcap, they churn the portfolio 0.10 times, but they deliver only 33%. What it clearly shows, because even you are not churning, you are not delivering returns, it is also bad. You churn more and you are not giving, that is also bad. It's also bad, okay. So the churn is not a problem. The churn, if you do that, you should have deliver return. For this similar case in this, if you talk, for example, they churned 3.4 times. Assume they lost 25.25 basis points for every churn. Probably they are been poorer by at least 1% return. 1 percentage point return is poorer in quant mid-cap. Instead of 36.6, they could have been at 37.6 if it had churned very less. So we cannot surely know because the fund manager has churned it. By and large, Quant has undergone one particular change, was that because they had an higher exposure to Adani group of stocks, at certain point in time, due to some lot of informations, negative informations war in the market, and to curtail their losses, Quant could have sold the Adani holdings. That could have added, its churn could have been there, because they have a technical strategy. And if you look at it, Quant portfolio across the schemes, let it be large, mid, small, whatever the schemes you look at it, any 1-2 stocks they identify, it will be top in all the schemes. Let it be large cap, let it be pharma, let it be mid cap, let it be small cap. That 1 or 2 stocks which they were strongly bullish, there will be 1-2 stocks will try to corner 15% of the portfolio or 20% of the portfolio. That's the way they operate it. Because of that, they have churned some portfolio, it's not delayed. We have to see that in the subsequent year whether they are able to compensate for the churn they have done in the subsequent year. When you look at it, small cap funds, technically look at it here. The fund Quant, it's a new fund, it's a Quant small cap and all, it's less than 2 years old. Even in that, they churned the portfolio 1.5 times. Okay, that means they have delivered return of 48.9 by churning the portfolio 1.5 times. Whereas if you look at it, a Bandhan, they churned their portfolio 0.87, but they delivered a return of 57.7%. The gap between the Quant and the Bandhan itself was close to around 9%. Both have churned very less. So that means the amount of churn has delivered better return for Quant, but it is not able to beat a fund which has done a less churn. Let's see another interesting case study here. Canara Robeco small cap, normally their portfolio turnovers always will be very, very less. Similar to Canara mid cap, Canara small cap also had a churn of 0.8 times, but they deliver only 34.48. Look at it now, assume the HDFC Quant small cap has churned the portfolio 1.5 times, but they delivered 14.45% percentage points higher than Canara Robeco. So that clearly exhibits that if you don't churn the portfolio, you are a superior. If you churn the portfolio, you are inferior. It is not like that. Irrespective of whether you churn your portfolio or not, end of the day, a customer requires only a return. If a fund manager is able to deliver the return, there is no problem. You and me know that the mutual fund is a discretionary type of portfolio. That means we don't have a rights to tell about which sector to be bought. It is about discretion of a fund manager to decide on that. The moment we decide and hand over the portfolio to fund manager to decide, and whatever he decides, it should be going to be the outcome of that. What we can see is that a fund is churning the portfolio more frequently, but the returns are not coming. It's a bad. And one more thing you have to keep in mind, when the portfolio value is very small, they can churn more. Okay, the size is becoming bigger, they find it very difficult. If you look at it, even in a Quant small cap, they have close around 10 to 11,000 crore their AUM. Because of 11,000 crore, to churn a portfolio, it will give a lot of pressure. If your portfolio size is very less, they can churn more. Because it is to buy and sell, the impact cost, what we call is impact cost. That means when you sell, market also identifies somebody is selling huge quantity, the share price becomes. For example, a share is 100. This fund manager wants to sell 50 lakh shares. The moment order is been placed, market will sense that there is a huge seller is available in the market. Overall, the price will probably started selling at 100. By the time you try to sell the entire 50 lakh stocks, probably the stock could have been down by 5-6%. So much of returns will get impacted on his overall portfolio. So churning is very, very risky bet for any fund manager. Unless he is very confident, he cannot able to sell that. So you have to understand that whether because of churning a portfolio is bad, if portfolio has not been churned is good. It's not like that. Though the theory says desirable level of portfolio churning is low, but theory is different than a practical. So what you have to, you just keep looking at your fund manager's ability to generate more return when you do it too much of portfolio turnover. A lot of investors think that they can able to manage it. They can able to manage, but they also need to go through the fact sheets, understand a lot of ratios is available within the fund and then decide it. 15 days back, one of the investors came to us. Before he came to us, he has invested elsewhere. Now we went for a portfolio review. We found that a lot of funds of ours have outbeaten his holdings by 14-15 percentage points. So then he said, sir, please, I'll move all that to you. You please manage it. I'm not able to manage with my work schedule. I'm not following my schemes. So this is what happens at times when investors are not planned and they are not gone through the data before they are buying a mutual funds. So hope this video could be useful and given out a clarity on portfolio turnover. So if you are a first time investor to my channel, please do subscribe to my channel as a subscriber. And if you like this video, please do share with your friends. If you want any new video, please put in the comment box. We'll meet. This is Suresh Parthasarathy, Certified Financial Planner, founder, myassetsconsolidation.com. Signing off. We'll meet in some other video. Bye then.